Hello. Pray tell, who is this? Hi, Jamie. You need to unmute.
Good morning.
Hi, Jamie. How you doing?
Great. How are you?
Good, good. You're not in Carolyn's class, right? You're in my class, right?
I am.
Oh, you're in Carolyn's class.
I am. I'm in both.
You were in my 110 class, right?
I am.
Okay. I wasn't sure. I was going crazy here. How do you like Carolyn?
I really like it. It's been really nice so far because the material that we're covering in 110 has been very closely aligned with 230.
Yep.
So, right now it's starting to deviate. And for me, feeling like very complex in 230 and just like a lot of new concepts and things like that. So I'm really excited.
Excellent.
About the
So Carolyn's not really a nasty old goat? No, I've been making that joke about all the lady teachers all the time, and I'm gonna get in trouble one day. Okay, I have a feeling it might be just the two of us, huh? First of all, does she videotape her lectures?
Yes, she does.
Okay, what's what we're doing now?
Yeah, I think that people have messaged her and the class too because they are having trouble attending if they don't know it far enough in advance to plan. Yeah, so someone might pop on, but I just happen to be checking my messages right now, so that's why I
Well, first of all, I have to warn you, there seems to be a vicious-looking animal behind you there. You're okay with him, huh?
I have the little dog on one side and then my cat's on the other.
All right, looks like we're getting another person here. Daniel is here. All right.
Yes, hi.
Hi, Daniel. Hi, I'm Bob. How you doing?
I'm good, thanks. How are you?
Good. Do you want to show your mug, Daniel, or you want to hide behind anonymity there?
Well, I am unshowered, so I'll probably just hang out.
No problem. Okay, this is Jamie, Daniel. You guys are in the same class, I suppose. Okay, I guess we can get going. I don't think we're going to get too many more people here. It's chapter 9, I understand, huh? Chapter 9. So let me see if I can rack up the screen share here. Share screen. Go here, open. Bear with me.
Jamie, what did you think about annuities?
Honestly, I had so much trouble with it.
Me too.
I was doing
my God.
It took me like 3 hours to do that.
Yeah, those last like 10 problems. Well, I guess it's more like 20 because it's like you have to do 2 for each section. Yeah, it took me forever.
Yeah.
The annuities are difficult.
Yeah. I thought I just have to watch more videos, and I feel like there's just something I'm not getting about it. That's why I was really excited about this lecture too.
We'll clean that right up as soon as I can figure out why this thing isn't letting me share.
All right.
Okay, hold on here. I had this problem the other day, but we figured it out. Okay, bring the error. We go here. Oh, for Pete's sake. What's happening is when I go to share, it doesn't show the file that I want to share, which I've got right here. And I don't quite understand. Okay, maybe now, let's see. Oh, goodness gracious. Isn't this embarrassing? Give me a moment here, Jamie. There's the file. That's the file we want. Share. Oh, come on, please. I hope we don't have to do this through the book, huh?
So you can screen share like your web page or something?
Yeah, we'll figure something out here in a second. And I apologize, guys.
It's
I
okay.
thought I was getting pretty good with this, and now all of a sudden, I'm back to looking like an idiot here. Okay. There is our PowerPoint. I open up the file. It's sitting right in front of me. Screen share.
I'm wondering if you start screen sharing and then open the file, it'll work.
Okay, so you say screen share, and then open the file.
Yeah.
Okay, let me try that. I'm closing it now. You know what else? I have an idea. Let you guys be the co-host, and you got the PowerPoints, right?
Yeah,
But
that
you
could
don't-
work too.
Yeah, you don't have my PowerPoints though, and that throws
Well, I
my
don't know in PowerPoint, but
mojo off. But that's okay. We'll get there. Oh, for heaven's sake. Okay, share screen. Now you're saying go in and open the file that I want to share.
yeah, so share like your desktop and then open up the file from there.
Okay, I'm going into the okay, 230. This is the one I want to share. I open that up. Okay, that file just opened up.
Yeah, but you're not screen sharing yet.
No,
we
no,
can't-
no. No, that's what I'm saying. I'm trying to screen share. Ah, okay. Who am I talking to? Daniel?
Yes.
Okay, Daniel. Tell me what you're asking me to do. You said hit.
So you can start this. So can you start the screen share right now?
Yeah.
So just start it and show us your desktop.
Okay.
There you go. All right. And then now go ahead and open it.
Open up the file.
Yes.
Ladies and gentlemen, here we go.
Boom.
Daniel. Oh man, I know who's getting an A in this class. You can see the PowerPoint now?
Yeah, I can see it.
How come the rest of the faculty never told me? I bet they don't know, huh?
Yeah, probably not.
Daniel, you're okay. Are you a baseball fan, Daniel?
No, not really. More like I like UFC.
Yeah, me too. Hi. Okay, here we go. We're going to make annuities so that you know what we're talking about, all right? After you got through the 110, Jamie and I were just talking about how the first 5 chapters of this class pretty much mimicked 110 if you took 110. And now we're getting into some new stuff. We started going through the balance sheet now, huh? We started with cash and receivables and some issues there. Then we went into inventory and cost of goods sold. And then, of course, we went into fixed assets. Now we're getting into the liabilities here. And chapters 9 and 10 go together. Chapter 9 and 10. And what I hope to succeed with here is getting you to understand this one important concept. And it sounded like you were confused by it, called present value, right, Daniel? Okay, here we go. In chapters 9 and 10, we're talking about a business financing by borrowing money. When you get to chapter 11, it's going to be a company raising money through a capital stock exchange where they're going to issue stock to the public. So these next 2 chapters are about debt, okay? Debt is riskier than equity. One of the disadvantages of issuing debt is you have to pay it back, okay? Whereas if you issue stock to the public, you have that money from them to pretty much do whatever you want. So debt has interest expense you have to pay, and creditors can come right after you and put you out of business if you don't pay your debt. I think we know what a current liability is. Anything under a year? Anything over? That was a tricky effect, huh? And we'll probably just skip over this grid here. We know what accounts payable are and accrued payable. Note payable, not accounts payable, right? Notes payable is borrowing instrument, and the deferred revenues, that's your unearned revenue. You see this thing on payroll? We're going to skip right over it. I don't think any of the teachers go over this for one good reason. We have a whole payroll class that you might want to take. So I'm going to skip right that. And deferred revenues, this is your unearned revenues. This is from accounting 101, 110. This is in the example they're using here, the gift cards. So let's get into more of the meat of what we're trying to do here. We'll start with some simple notes payable. Note payable, that is a borrowing arrangement. Notes payable is different than accounts payable. Accounts payable represents the relationship, the debt that you owe to your normal suppliers. If you don't pay a supplier, they're not in a position really to charge you interest. Of course, they'll come after you for the payment, but they don't have the leverage of a note. A note has an interest rate that is fixed for the length of the note, and interest expense needs to be accrued, and interest receivable would be too, okay? And so let's see what we're talking about. Toyota borrows $100,000 for 2 months at an annual interest rate of 12%. Compute the interest on the note. Whenever you see a percentage on a note or a bond or virtually anything, you are talking an annual rate. That's 12% a year. And it clearly says that, an annual interest rate of 12%. So when you're going into this chapter and you're working with bonds and you're working with some present values in a few minutes, you're going to have to say to yourself, that's 12% a year, which is $12,000 or $1,000 per month. And they're showing you that simple calculation there. Okay, I think we're good with that, I assume. So it's 12% a year is 1% a month. So 2,000, that would be the 10,000, okay? May refinance it, maybe. This I'm going to skip. I don't think this is of any great interest. Of course, I may get a phone call from Carolyn later saying, why didn't you go over this? Let's have a little fun with this before we get into some numbers, because I'm sure there'll be some things on the test. Contingent liabilities, contingency. It means something that will happen in the future due to some action that happened now. If I go back to my diet, I will lose weight. I will lose weight contingent on dieting. You will earn good grades contingent on your studying. Contingencies. These are things that could happen based on something that's already taken place. And what we're talking about here really, Jamie and Daniel, are lawsuits. Lawsuits is what we're talking about, okay? Companies get sued unexpectedly. Some companies are in businesses where they're getting sued all the time. And there's some accounting rules we need to understand. If you are getting sued by somebody and your legal people say, we're probably going to lose this lawsuit. What happened? You know, your legal people say, what happened? Well, Daniel held a meeting with a visitor and Daniel punched the guy in the nose. We're pretty going to lose that. We're going to lose that for sure, right? So that would come under the probable line. Probable. We will record it as a liability, okay? But only if we can estimate it. So there's a little tricky note there. If we think we're going to lose the lawsuit and we know how much it is to a pretty good degree, we're going to debit lawsuit expense or something and credit lawsuits payable or legal fees payable or something. If someone sues us for patent fraud or something, and our lawyers say, we think we're in the right on this. We're pretty sure we can win this, but it could go either way. If that's the case, you just disclose it in the notes. You just disclose it in the notes. You'll see a note next to one of the payables, and it'll explain all about the case. If it's a frivolous lawsuit, if somebody, sued you, if Colonel Sanders sued you, Jamie, for stealing the name Sanders, obviously that's a stupid lawsuit. You would not have to do anything with that. So these are three silly, exaggerated examples, but I think you get the idea. The only one you do record is if you know what the amount is and you think you're going to lose. Okay. And they're giving you some definitions here, 50% to 70, we're going to probably lose it. Okay. Contingent liabilities. I think we know what working capital is, huh? Current assets minus current liabilities gives you working capital. It's the dollarization of the current ratio. Current assets divided by current liabilities, that's your current ratio. Subtract them, and that's the amount of money you have. The working capital is the amount of money you have right now that can pay down every dollar of your current assets. Changes in working capital accounts are important, very short-term item to be checking. Affects the cash flow. Working capital has a significant influence. If you don't have enough working capital to pay your current liabilities, you're underwater and there could be a problem, okay? Here we go. Now we'll get into some borrowing arrangements. We're going to get into some borrowing, and then we're going to hit the concept of fixed assets, single number, and not fixed assets, bonds payable. And what does this say? Long-term liability. Okay, there it is. Yeah, you might have to pledge some collateral if you borrow money. We'll kind of skip that. That's pretty easy. Here is a pain in the neck area that you need to know. We need to know this. A lease. A lease is a situation where maybe City College brings in a copy machine and they're leasing it from Xerox. There are two types of leases with two dramatically different impacts on your financial statements. Operating leases, short term, and it is an expense. There's no liability or asset. Operating lease, an expense all the way. The best example of that, again, we lease a copy machine from Xerox. And the deal is we pay Xerox $200 a month to lease that copy machine for 3 years. And then at the end of 3 years, Xerox takes the machine back. That is an expense. We didn't buy that machine. We leased it, a pure expense. A capital lease is totally different. Here, we're leasing that same machine, but under different circumstances. A capital lease is not an expense. It is just that. It is an capitalized asset. You're going to put that on your balance sheet as leased equipment or something. And there are 4 criteria that make it a capital lease. And I'll read these off and talk about them a little bit, but you just have to read this slide or whatever Carolyn provides for you. These are my slides. If the deal is you lease a machine, let's say for 4 years, but the machine really just has a life of 3, you have bought the machine. You haven't leased it. So you cannot call that an expense. You're going to have to debit the asset account called capital lease or leased equipment and credit cash or whatever. If ownership of the asset is transferred to the lessee, the person who's leasing the machine, it's now a capital lease. If at the end of the lease period, you own it, you bought it, you can't pretend that those payments you made for these 3 years are an expense. And if you have a sweetheart deal to purchase the asset at a price lower, again, that's considered you're buying it. And then the one that's a little more complicated, if the present value of the lease payments is 90% or more of the fair market value of the asset when the lease is signed, that's a little more of a complicated one. What they're saying is, if you're going to get 90% of the fair market value out of that lease, it's a capital lease. Now, we just went through the rules. Let me go back to that and just trying to clear this up, make it a little easier for you. An operating lease is an expense. If companies had their choice, they could decide if they wanted to be an operating lease or a capital lease. I would think companies might be inclined to go for an operating lease because that's an expense, and that will reduce their tax burden, turning it into an expense. On the other hand, a company might say, I want to show as much profit as I can. I'm going to call it a capital lease. You just can't call it. It's either one or the other. And there's a company called WorldCom, and we might see that slide coming up. I don't know if it's in this chapter or the prior one. WorldCom was one of the many companies involved in the great scandals of like 2000, 2001. And what they did, they had a ton of leases, and they put all of them as capital leases. Most of them were not capital leases, but they called them that to maximize their income and deceive the investing public. So long-term leases, notes payable, mortgage payables. Small debt can come from any place, right? A bank, an individual, a pension plan. Debts can be sought from in many, many areas, okay? Let's talk big debt, okay? This is when you get into chapter 10, but we're hopefully when we get out of this thing today, Daniel and Jamie, you understand how to compute a bond, so you're really ready for chapter 10. Company really wants to borrow money. Coca-Cola wants to build a new bottling factory in China, for example. It's going to cost $500 million. Well, Coca-Cola can write a check for $500 million, but what they might do is issue a bond to the public. They'll issue a bond to the public. A bond is a debt. A bond is the action of borrowing money. They will write up a prospectus of some information, and they'll announce to the public, Coca-Cola is issuing a bond effective June 1st, 2020, and the public is invited to loan us this money. And we will pay so much in interest, and we'll pay it for so many years, and we'll pay the interest, and then we'll pay you back after those years. Bond, it's called a bond issue, a bond issue. By the way, that is not me in the picture. I get a little annoyed when students ask me that, okay? So let's take a look at this. Present value. Whoa, present value. In 25 years, $1,000 invested at 10% for 25 years will grow to $10,834.71. This is the future value. This is the future value. 25 years, this $1,000 is going to be worth that amount. In 5 years, it's worth this. As it grows, it's going to be simply 1,000 times 1.1 times 1.1. We understand the growth concept. Present value. What is the actual dollar amount today? Okay. This number here, 1610.51, this means that in 5 years, $1,610.51 will buy what $1,000 buys today. It's called inflation. Okay. Money, if I borrowed money from you today, if you loan me $1,000 today, and the deal is I pay you back in 5 years and I give you back $1,000, you really got screwed, because I really should have paid you $1,610.51. Present value, what the money is worth today. So we're going to be looking at investments where we're going to have a future value, and we're going to decide whether that investment is worth it by discounting it back to its present value, okay? So let's continue as we look at this concept.
But the present value is $1,000.
Exactly.
Right,
yes.
okay.
$1,000 today. That's the present value. The 10,834.71, that's the future value at 25 years, 25 periods at 10%. Okay. Talking about the time value of money. If $100 is invested today, how much would you have in 1 year? I'm going to go out on a limb and say $108, right? It's 100 times 8%. Now you have 108. You multiply 108 times 1.08 again, you're going to get the same calculation, and the money grows. So what we're talking about is how much would you have now in 2 years? 2 years, you just bump it up, and so on and so forth. The $100 is the present value. These are the future values. Now, I don't know if Carolyn gives problems out with future value. I think she does. I don't really do that hardly in my class. Everything is a present value calculation. And the reason I kind of do it that way is I think you understand this part conceptually, which is the main thing. You know, $100 times 1.08 times 1, et cetera, is going to grow to a higher number as you go along. There's a formula for doing this. If you're a math nerd, if you like to do formulas, I don't think I could do that formula really easy without reviewing my math skills. But there's a formula here. The present value times you bracket 1 plus the rate of return times the number of periods. Okay, if you like to work with the formulas, that's fine. That's fine. Here's your formula: $100, 12% plus 1. That's really like going 1 point times 0.012, and you get a present value. You get a present value number of 7970. This means that $100 in 2 years. I'm sorry. Yeah, that's right. $100 in 2 years is worth 7970 today. So why is this so important? Well, this is the whole thrust of the next 2 chapters. A bond that pays $100 in 2 years is today worth $79.70. Another way to say it is, in order for us to have $100 at the end of 2 years at 12%, we must put $79.70 in the bank today. So here's where the decision-making comes in. Daniel, you sound like an investing type. What if I said to you, this is the deal, and you have these numbers in front of you. What if I said, I'll take this off your hands right now at the beginning for $90? Would you accept that bid from me?
The bond?
Yeah, I'm saying to you, you have this investment. You just made this investment this second. And I come in and I say, Daniel, I'll take that off your hands if you want to sell it. I'll give you $90 for it.
Yeah, I would take that.
How come?
Because I only paid $80 for it.
Right, because yes, that's one way to say it. Yeah. The present value of that $100 is only worth $79.70 today. So if someone gave you $90, you'd probably grab it. Okay. Now, working with the formula is not what you're going to do in the class, unless Carolyn really wants to be nasty with forcing you to do that, okay? A bond will pay $100 in 2 years. What does it mean? If $79 is put in the bank today, you'll have the $100. The $79.70 equals the $100. They have the same buying power in each of those 2 years. $79.70. You can buy a nice shirt for, say, $79.70 today. But in 2 years, if you walk into that store with $79.70, the guy say, you owe me another $20, huh? So let's understand this. Now they're going through the calculation again. Let's verify the 7970. And we're going to do it a different way. We are not going to use that mathematical formula unless you want to knock yourself out. But we're going to go to the tables in your book. And if you don't have the book with you, it's Appendix E in your book, the present value tables. You should have that in front of you. If not, I do have that available to share again. Okay, so here's what we're talking about. We start with $79.70 times 1.12, or multiply it by 12% and add the same thing. At the end of the first year, the future value is 89.26. Now, if somebody offered you, say, 89 for this, you ignore the person. It's not worth it. Next year, 89.26 times 1.12, there's your $100. Just a little rounding, that's all. Now we're going to do this using the table. Look at your present value table. There are two tables there. And Daniel, you mentioned you were a little bit stymied looking at the annuities, trying to get those numbers. Let's take a look at this. You have two tables. Well, there's three if you count the future value, but I'm just going to talk about the present value table and the annuity table, because those are the two components of a bond, and that's where we're going. Okay, so let's see what we have here. We'll go back. 12% for 2 years, huh? 12% for 2 years. You recognize that number, Jamie? That's the 79.70 we began with. The present value table, every one of these numbers equals how much? $1. These are all $1 under these scenarios. So we had a 12% bond for 2 periods, which means that $1 has a present value of 79 cents. Okay.
When you say it like that, it makes sense.
Yeah, it's a little tricky. I just try to make it easy as I can. Boy, when I was teaching, I got a couple 230 classes now, and I know this is a tough nut when my guys get to it. Okay, that's the present value of $1, 79.7 cents, 80 cents, say. Okay. How much do we have to invest today at 10% if we need $1,000 in 3 years? You want to look at your table and see if you can tell me the number? Would you rather me show you?
Yeah, I don't have the table in front of me.
Okay. All right. Well, let's take a look at it. 10% for 3 years. The future value is 1,000. How much do we have to have in the bank today? Well, it's going to be the 751, because you go to the table and I see that conversion there. 3 years, and what was it, 10%? 3 years, 10%. $1 in the future, under this scenario, 3 years, 10%, is worth 75 cents today. You need to put 75 cents in the bank today if you want to have $1 in 2 years with the same spending power. So get comfortable with the present value. One thing students always trip themselves up with, I've noticed over the years, is they always tend to confuse the future value with the present value. The future value is just that. It's not what the money's worth today, the present value. And everything we're going to do here, and if I do chapter 10 with you next week or whatever, hopefully Karen will be back. If not, everything we're going to do is present value calculations. We're going to go crazy with them. And they're just showing you this grid again. Okay, so that's a quick look at the present value of a single number. Get comfortable reading, working with the present value table. Also, when you're doing your homework, be sure to use the present value table that's in your book, because if you don't, you might have a present value table with an extra decimal point. In other words, your book, I think, has 4.7513. If you're using one from the internet, it might be 0.75131, and that's going to throw the answer off just enough where you'll go nuts. You'll never get the exact right answer. An annuity. Okay. A bond has two parts. When a company borrows money, they borrow a present value, if you will, of say $100,000, but they also have to make a series of interest payments. Such a series of interest payments is called an annuity. An annuity is a series of equal is a key word, equal payments, same interest rate for a finite amount of time, for the length of the bond. So we have a separate table called the annuity table. And it's very easy to get lost in the weeds. Present value, future value, you get that right, and then you go to the wrong table. If you go to the wrong table, you get such an absurdly wrong answer, you'll probably intuitively know you're in the wrong table, but you wasted some time, huh? So let's see what we have here. We have a series of payments that we have to make in the future. In the future, we have to pay this amount, we have to pay the same amount again, we have to pay the same amount again, and then we have to pay whatever we borrowed back, okay? So let's see what we have here. What is the present value receiving $1,000 each year for 3 years at this interest rate, 10% compounded annually? We have to go to the annuity table. Do you have the table in front of you, Jamie? Haha, then I'm going to make you do this problem.
Yes.
Daniel's pretty smart. Huh? He's got the table. No, I'm only teasing Daniel. So look at your annuity table. Go 10% for 3 years.
Okay. 2.48. So it would be D.
Yeah, exactly. How easy was that, right?
Much easier than when I was doing it alone.
Well, like I said, this is not the type of thing where sitting down and doing it in the book is going to be efficient. Of course, that's the way, the people we've learned it for years and years, and you'd get the hang of it. But when you see it demonstrated, it makes a little easier, I think. Okay, so an annuity is an equal payment at the same amount for the length of the investment. I get a pension from my old job. Every month I get like $4 or whatever, a pension. It's the same amount. That's an example of an annuity. Okay. So here we're getting into an interesting little problem here. And in my class, I always put this thing on the test with, different numbers, but here, Starbucks bought some new delivery trucks. And look at this deal. This seems pretty good, huh? The company signed a 2-year note agreeing to pay $200,000 on December 31st, 2017. Shows you how old this slide is, huh? Market interest rate is 12%. Here's my question, Daniel or Jamie. How much is the future value?
It's 200,000.
Yeah, 200,000. That's the future value. Okay. Now, if they were going to pay the whole 200,000 today, we would debit delivery trucks or delivery equipment and credit cash, and that would be the end of it. But this deal here, we don't have to pay a penny, not a penny for 2 years. What that means, Daniel and Jamie, is we have to record this purchase not for 200,000, but for the present value. The present value. Take a look. What's the future value? 200,000. Assuming 12% in 2 periods, what is that equal to today? 1,594.40. Make a little sense, Jamie? Okay. All right. So we can't debit 200,000. It's only worth 159,440. If Starbucks called us up today and said, hey, I want my $200,000 right now, we would cut a check for 159,440 and hand it to them, and they'd be happy. So let's see if they show us the journal entry. Take a look. Delivery trucks, 159,440. Okay. But we have to pay 200,000 at the end of 3 years or 2 years, whatever this was, 3 years, I guess. We have to now record the interest expense for the first year. And I'm going back. It's 12%. 12%. Do you have a calculator, guys? What's 159,440 times 0.12?
$19,132.80.
That sounds about right. So let's see. There you go. 19,133. That is the interest expense for the first year. So right now, on our financial statements, we have this hard number, 159,440. But at the end of the year, the present value has changed with the interest. So let's see what we're going to do with this. Look at that journal entry. You debit interest expense. I'm sorry, get that out of my way. We debit interest expense and we credit notes payable. What was the present value of this note when we signed the deal? 159,440. After a year, this notes payable has gone from 159,440 plus 19133. 19133. Jamie, I'll put you in charge of the calculator. Add these two numbers up now. 159,440 plus 19133. And you should get what? 178,573, I believe.
Mm-hmm.
Okay. That's the present value after 1 year. If Starbucks called us up after a year and say, I want my 200,000 now, we would send them a check for that number. Hang on to that total at 178. Multiply that now times 0.12.
$21,428.76.
Right. So what's our journal entry going to be now? We're going to debit interest expense and credit notes payable for that amount. Why is the interest expense higher in the second year?
It's compounding.
Yeah, because the note payable is going to keep going up until we hit the lucky number. So let's take a peek. We debit interest expense, credit notes payable. Do you still have that 178 number in your mind? Yeah, let's do it this way. Let's make it. Here we go, Jamie, Daniel. 159,440, right? Plus 19,133 plus 21429. What number did you get when you added those three up?
200,000.
Yeah. And now we write them a check for 200,000. So what we've done is we've taken into consideration in 2 years, we have to come up with 200 large, which today is worth 159,440. At the end of a year, obviously the 159,440 is going to be a higher number because we got to pay interest and etc. Make some sense, Daniel?
Yeah, it makes sense. I think what confused me is like with the other calculation, the interest goes down.
Yeah.
I think I would get them confused.
That's a different scenario. Yeah. Here we're starting off with a present value with no money being exchanged. In the other scenario, you'll be paying the note down as you go. Here, we're kind of accruing it up is what the difference is. And there's some good examples there. Here we go. Let's do our first bond. You're not supposed to know that this is a bond right now, but it's the same exact calculation. Starbucks is busy, huh? They bought roasting equipment and they agreed to pay $1,000 a month for 20 months. That's an annuity, guys. We have to go to the table, the present value table for the annuity. They also have to pay an additional $40,000 one lump sum payment at the end of 20 months. The supplier charges 12% interest. Okay. The 1,000 per month for 20 months and the 40,000, is that the present value or the future value? Shouldn't have to hesitate. Remember I told you get stuck between the present. This is the future. We agree to pay in the future. Future value, future. We're always going to try to have to come up with the present value. In other words, how much money do we need to have in the bank today to cover the $1,000 a month for 20 months and the one payment at the end? So let's divide and conquer. They're asking us to do the annuity first, okay? I think when you go into your book, it embarrasses me because they don't have the 1%. Where did they get the 1% number here? It's 12% a year, right, Jamie? So they're just saying divide that by 12 because they're not compounding. Okay. So go to your table go to your annuity table, guys. 1%, 20. It may not be there. I'll just show you here. 1%. You go to the table. 1%, 20 periods. So that takes care of the annuity portion. But what about that single number there? We have to pay back the 40. Here you would go to the present value of a single payment, a single number, your other table. And again, it's going to be 1% for 20 periods. And when we get this number, the annuity and the single payment, we add them together. You go to your table, and like I said, it may not have the 1%, or you could go, I guess you could go 12%, divide by 12, but let's not worry about the table. You go to the table, 1%, 20 periods, that's the conversion, okay?
It's there.
Multiply it out. To cover the $1,000 a month, we have to come up with $18,046 in the bank. That'll grow enough to cover the 20,000. On the present value with the number, the 40,000 future payment has a present value of 32,782. We add those two numbers up, we need 50,800 was that $28 in the bank today in order to pay this debt. What do you think, Jamie? Makes sense?
I'm still processing it, how I would figure out the 1% at the beginning. Can you explain that to me again? Sorry.
Well, it's for 20 months, right?
Uh-huh.
And the annual interest rate, remember I told you, whenever you see a percentage on a bond or almost anything, what period does that represent?
A year.
A year. So you just divide it by 12 months, it becomes 1%.
Oh, got it. Okay.
That's all it is. That's all it is. And that confused the heck out of me when I've been at this school, I don't know, 7-8 years, and I started as a tutor. The first time I saw this, that kind of drove me nuts too, especially, of course, they didn't have that conversion in your book, I don't think. All right. That's the end of this chapter. Now, Carolyn's slides are more detailed. I'm not going to go into hers because I'm not conversant with them. But this is a brief introduction. Do you want to look at chapter 10 a little bit? Or are you happy with this bite-sized piece here? Do you have questions?
I think I'd rather ask you some questions.
Go for it if you have questions.
Yeah, I'm trying to think of exactly what I'm confused on. I mean, like, it all makes sense to me, but when I actually start to do the problems, that's when it changes, and then I start to like jumble it.
Yep, yep, yep.
Um,
yep.
so I guess what confuses me is like with $1,000 per month, you're multiplying it to make it bigger, but then with the $40,000, you're kind of making it smaller.
No,
It seems
no,
like.
no, no, no. We're making the present value number will always be smaller. This is not $1,000. It's 1,000 times 20,
So it's
$20,000.
$20,000.
$20,000 paid out over 20 equal payments of 1,000 requires this amount today.
So then in total, you're paying $60,000.
Yeah,
So then you're basically saying the present value of $60,000 is 50,828.
yep.
Yeah, I think that was what kind of got me.
Exactly. Do you see what we're talking about there, Jamie?
Yeah, I was just gonna say I was reading it the same way as Daniel, but then when we looked at it just now, it clicked.
Yeah.
Yeah, that's starting to make more sense. I guess I also kind of got confused with like, so then this is separate than say if you're like no, I guess it's not like, so what's the difference between this and when the interest is declining?
The declining example.
Uh-huh.
Let me grab it right from the book here. Hold on. Jamie was in my 110 class, Daniel. How about that? Huh?
That's cool.
She'll tell you stories. You heard the bad jokes and everything, right, Jamie?
I love the jokes.
Huh?
I love the jokes.
Yeah. A certain boss of mine doesn't care for them, but that's okay. If you look at, here's an example. I'm just looking at the book. I'm not going to read the problem, but the type of thing. Here's a situation. Here we go. The one that goes down is where you're paying annual payments, Daniel.
Mm-hmm.
In your book on page 178, Starbucks is buying the same equipment, okay? Only, well, this is a different problem, different numbers. Starbucks is, the problem here is going to make 3 annual payments of 163,000, okay?
Okay.
And they come up with a present value of $400,000. They went to the annuity table, right, Daniel? 3 payments at whatever the percentage is here. I don't even see it. 11%. 3 years at 11%. Those 3 payments of 163 require 400,000, right?
Mm-hmm.
So now you're starting with the full 400,000. Now you're going to take the first payment, in this case 119, and I'm sorry, the first payment is 163. They'll all be the same, 163. You multiply 163 by the interest rate, you get a number. And when you subtract that number from the 163, the remaining balance is the amount the note comes down. Let me make it a little more clear on Excel thing if I can, okay? Could you hold on?
All right.
I might use your trick again. Let's practice that if you don't mind. Okay, so you suggest I open up the file first? Or
Yeah, I would just minimize your PowerPoint here
that's, yeah, okay,
and then just open up your Excel while you're still screen sharing.
yeah, okay, we don't. It doesn't matter what I open. And that's going to share automatically, huh?
Uh-huh.
Okay, let me open up a new window here. Here's what I'm talking about. In the book, we have a problem like this. And let me just, Jamie's heard this before. Do you ever watch the Big Bang Theory on television, Daniel? You know that show?
I've seen it, yeah.
I'm Sheldon Cooper. I have to go through this little thing here, okay? So we're going to make 3 payments. 3 payments. And I'm going to use what's in your book. 3 payments of, what was that number? 1.85. Okay? 685. And the attached interest rate is 11%. 11%, okay? 11%. Okay, so we go to the annuity table and we find out that we need $400,000 now. Or I'm sorry, I said that totally wrong. We're going to be paying in the future these three payments. 163,685. That's going to add up to the total future value.
Mm-hmm.
So we're going to start by getting the present value of these three payments, okay? These three payments have a present value. Yeah, we're going to debit. It was distracted looking in the book. You know what they're calling it now? Not delivery stuff. They're calling it espresso machine. Okay, so we're going to debit espresso machine. And we're going to credit notes payable. Okay. And the debit will be for $400,000. Okay. 400. We are going to have to make a payment. We're going to have to make a payment. Keep getting distracted by the interest rate. We're going to have to make a payment of 11%. 11%, 0.11.
But why is it 491,000?
That's going to be interest. That's
So the
going to be,
espresso machines are worth 400,000, but we're paying 491,000 in total?
yeah.
Huh.
Yeah. But the gist of the problem, though, is, Daniel, how do we record it from the beginning? Here's how. We're going to say to ourselves, we have 163,685. The right numbers here. There we go. Here's what we're doing. This is how much we're going to be paying, okay? Let me get rid of this because that's a crazy, a long way to do it. 400,000. There we go. There we go. 400,000 plus 400,000 times 0.11. That's your interest expense, okay? So at the end of the first year, we know that our interest expense is $44,000. That's pretty easy. How much did we say the payments are every period?
Yeah, the 163.
Okay, so that's going to be not a credit to notes payable, but a debit. That'll be our hold on. That's the cash. What is it? That's the cash. What am I doing, cash? See how easy it is to get lost in the weeds when you go too fast? 163,685. I see we only have a $44,000 debit. we have to have a debit here for the difference. How do you like that number? What are we debiting here, Daniel?
Yeah, the notes payable.
Okay, that my presentation was a little clunky there. So now that we did 1 year, let's take a look at it. We are buying a machine for $400,000, and we have to make 3 payments of 163,685. 400,000 times 0.11 is interest expense of $44,000. The cash payment is always going to be that amount. Therefore, any difference is the reduction of the note. So let's do this. Let's copy this down over here. We'll change the numbers. This is what you're asking about, right? Where the note payable goes down, right, Daniel?
Yeah.
Okay, so let's do the next year. The next year. What is the payment the next year? Well, it's going to be the same. But what's the note payable value after the first year? It's going to be 400,000, right? Minus the 119,685. And that's going to give us 280,315. You agree, Jamie, that's the note balance after the first year? What's
Yes,
the
that
interest?
makes sense.
What's the interest rate? 11%.
11. Mhm.
We multiply this out. Whoosh. The interest in the second year is lower, right?
Yeah.
And whatever the difference is goes, let me fix that, goes toward the note. Yeah, so take a look at it. As we go into the future, we're reducing this note payable.
Right.
Yeah, the $400,000. This isn't so much a present value problem as it is a note here. 400,000. How much do we need to cover this? Well, we know we're going to have to make these payments plus whatever the interest is going to be, and that's kind of what we're calculating now.
But in reality, we're paying $491,000.
I think so. If I didn't screw up. So this was a 3-year deal, right? Yeah. Okay.
I think that is what confuses me, because they're saying that we only owe 400,000, but then in reality we owe 491,000.
Yep. That's the present value, the 400,000. Okay.
400,000 is the present value?
Yeah, that's how much we need now, assuming these interest rates.
So they're giving us $400,000 worth of espresso machines,
Mm-hmm.
and we're going to pay them 491,000 for the same $400,000 espresso machines.
Yeah, exactly.
Okay, I think that makes a little more sense.
So let's finish it up then, okay? All right, Jamie, you're the keeper of the calculator, huh? We have a note payable of 119,685. That's been reduced. I'm sorry, we have a note payable of 400,000, right? Minus here, minus here. And that leaves us with this balance, 147,465. 147,465 times 0.11. And we're done.
That's amazing.
What's amazing?
The way that it worked out so perfectly.
Yeah.
I am looking at the book.
It makes
But-
sense now.
But you saw me stumble a few times. If you go too fast, it's very easy to turn to the table and you're looking at the number and you forget that you're supposed to be in the annuity table. Okay.
I did that too. I was in the wrong table a couple times.
Happens all the time. Happens all the time. The two things are that you're going to have to always be clear on, which is the future value number and which is the present value number. In the next chapter, it's a tougher chapter, but it makes it a little bit easier in that the future value is always a big number ending in zeros. because when companies borrow money, it's always like 10 million or 20 million. It's never Coca-Cola needs to build a factory in Shanghai and they need to borrow $8,332,412.08. No, it doesn't make any sense. You're going to see good, easy numbers to guide you that it's the future value. What else you got, Daniel?
So, okay. So the espresso machine is actually the 400,000 is actually the present value.
Yeah,
I
because
think that's what confused me.
yeah, and I didn't quite say it quite right. Yeah, this is the present value. If Starbucks demanded we make the payment now, how much would we pay them?
400,000, and then we just get the espresso machines right there.
Yeah, and then this all this stuff here would become moot.
Uh-huh.
It ain't moot.
But because we want the espresso machines now, but we don't have the money,
Right.
we have to pay more, because if we paid the same in the distant future, it'd be less actually.
Yeah, the note payable obviously goes down to zero at the end.
Right.
Goes down to zero at the end. So we're paying a total. So the interest is 91,055. Yeah, you said because the company didn't have the money. Yeah, that could be that they're forced to finance it this way, or it's a strategic decision. Maybe they're earning more than, I don't know how they're doing it in these days, but maybe they're earning more than 11% on their money.
Mm-hmm.
So it's easy, why would we pay out monies that we can earn 12% when these guys are willing to loan us for 11%?
Mm. Yeah, that makes sense.
Makes sense, Jamie?
Yes.
I think it's just keeping the two separate in my mind.
Yeah.
Like when they give us the future value versus the future versus the present value is what's really confusing.
Yep. Good. Just keep them separate and be comfortable using the present value tables. Remember that a percentage represents a year.
Mm-hmm.
I mean, the question before had 12% interest. If it was a $10,000 loan for 12% for 1 month, it's not 12% times 10,000, and then you pay that interest after 1 month. You have to divide it by 12 to get it back to a month. But that's pretty easy. I don't think you would have much trouble with that. I'm just going to show you. Daniel, if you don't mind, I'm going to practice your trick again here, okay?
Okay.
Your trick is to go to the desktop, right?
Mm-hmm.
Go to the desktop and then open up the file I want, correct?
Yep. Yeah, I think what's confusing you is you would probably open it up and then minimize it and then go back to Zoom.
Yeah.
And then when you'd hit the screen share, you'd only see your desktop.
I surely wasn't seeing what I wanted. Yeah.
So if you just start screen sharing onto your desktop and then open it up, you can go wherever you'd like and it'll
it
show
pops
everyone.
right there. All right, let's practice one more last thing because I did want to show you something here. Oh, come on. Can you read these numbers here? Can you see this?
Mm-hmm.
This is just a practice. I do with my class. I hand this out every semester. This is kind of what we just did with one of our examples. This is a bond calculation. bond. You're looking at a bond for the first time. We just did a bond, whether you realize it or not, when we did the one with the $1,000 a month for 20 months, right?
Mm-hmm.
Plus the single payment. That's what this is here. This is a bond. It has a future value we have to pay at the end of 100,000. We have a annuity amount of 10,000, and it's 10 years. Do you have the present value table there, Jamie? Just real quick,
Yeah.
we'll just do this first one here and we get out of here. Go to, which table do you go to now for this one? The annuity table or the present value of a single number? Hesitation. You see where I am right here?
Oh, the first one would be $1 and then the second one would be annuity.
There you go. So give me the conversions if you can there. I'll see if I can find it too. Appendix E. You know the old saying, once in a while we have to get our appendix out, huh? Let's find that here. I've had students physically attack me on these. Not really. It's not that bad. All right. What was the percentage? 10%, 8%, 10 years. 8%, 10 years is 0.46319. And then the annuity table. The annuity table. 8%, 10 years, 8%, 10 years, 6.71008. You're seeing the same numbers, Jamie?
Yes, I am.
I think we need a few decimals here, huh? I don't know why I didn't have this programmed already. Here's our present value.
I don't even know what I'm looking at, to be honest.
Okay, let's, this is the same thing we just did. We're borrowing money. We're borrowing 100,000 that needs to be paid back in the future. So we need to get the present value of that.
Yes.
We have
I
an
can
annuity
understand that.
of $10,000 for 10 years.
So we're paying $10,000 for 10 years?
Yeah, yeah. So in other words, the 10,000 for, we have to pay $100,000, right? 10 times 10,000. We need 67 now to cover that. And to cover this future payment way out in 10 years, we need $46,000 now. You add them up, and that's called the bond issue price. And I just went in there quickly. I just wanted to kind of just dip our beak in it for just a second.
But then the total is 200,000?
Absolutely.
But
We
that's
need
in 10 years.
Yeah. Over 10 years, we're going to expend a total in nominal dollars, non-discounted dollars, $200,000.
And so they gave us $46,000 right off the bat.
They loaned us 100,000.
They did?
Yeah. This is how much we borrowed.
Uh-huh.
100,000. In 10 years, we have to pay back the 100,000, right?
Yeah.
How much money do we now have to have in the bank in order to have $100,000 in 10 years? That's all I'm saying.
Hmm.
Little tricky, huh?
Yeah, it is. Do you think I could have this worksheet?
Yeah, that's not gonna be a problem. I can,
I was going to ask for that too. I feel like this would be very helpful to work through.
yeah, certainly not a problem. I'll put it on Canvas. I'll double check with Carolyn. She may not want me to, she may say, well, why did you get into the bonds? All you do is confuse people, but this is your little intro to the next chapter. But for chapter 9, be comfortable that you can come up with the present value of this $100,000 payment and these $100,000.
I don't know. I'm just still pretty confused because if they're giving us $100,000 right now, why is the present value not $100,000?
The $100,000 is the present value because we have to pay. That's the future value. That's what we have to pay back.
So we're getting 100,000 and we have to pay 100,000?
Yeah.
So aren't they just losing money?
No. Does it look like they're losing money? We're at the end of 10 years, we have to pay back the 100,000 we loaned, right?
Uh-huh.
That means today, present value of that 100,000 is the 46,319. We have to have that in the bank now in order to grow it to 100,000 in the future. But we also have to pay the interest, which is $100,000 split up into 10 different $10,000 payments. And for that, we now need 67,000 to do that.
Oh. Oh, so it's the interest.
Yeah. Yep. By the way, if you know somebody who's willing to pay you 10% right now, that's pretty good interest rate, huh? Okay.
All right.
All right. I guess that's enough for one session, huh? I'm gonna put this. I guess I'll save this. I have my YouTube channel. The Bob Smagula YouTube channel has these videos that I've done this last couple of semesters. I take them down after a while because they're in the public right now. But so you'll be able to find this video there, and of course I'll have Carolyn put it in Canvas. Okay.
Okay.
Thank you.
Thank you very much, Jamie. Thank you, Daniel, and Daniel, thank you a lot. I owe you a Diet Coke when we meet again, huh?
All right. Thank you.
All right. Bye-bye, guys.
Bye.